Gamestop is a popular video retailer operating in US. Here in Canada it's called EB Games, and they also have a bunch of stores in Australia and Europe. So for a while it looked like they're gonna go out of business because a brick and mortar is hard to compete with online retailers, with platforms like Steam, and also the new generations of consoles were not supposed to have any physical drives. However, in the last months, their stock went up by 100%, and yesterday it jumped by 22%. So I wanted to make this video to sort of cut through the clutter of the clickbait headline titles to see how you can evaluate yourself at any hype stock at any given time, to understand how hard it is to actually evaluate what is going on with the company. We're going to talk about what's going for the stock. We'll talk a little bit about what short squeeze is, and then we're going to look at the financials and really see what's going against the stock, and then I'll give you my own opinion on what we should do here. Hey, if it's your first time here, FFG Financial Freedom Guru is the website that gives no-nonsense advice on how to be smart with your money, build wealth while still living your life. If that is of an interest to you, please consider subscribing. Let's first look at what's going for the stock in terms of the headlines. So yesterday or a few days ago, Ryan Cohen, who is a successful business person who sold his online retailer to PetSmart for more than $3 billion and who apparently owns around 10% of GameStop, said that through his venture capital firm, he wants to take more active role with the GameStop and really transform them into the online retailer. And I actually got a statement from their annual report. I'll put it up on the screen, but it's like a consumer-facing, frictionless, omni-channel environment. Basically, they want to compete with Amazon in their own game. So I think just on that news that Ryan Cohen, who is successful, there is VC fund here, and they're gonna transform their business into online. I think that really pushed the stock up just based on those news. Another positive factor that's going for them is that we know now that the PlayStation 5 and the new generation of Xbox are still gonna have physical drives. We're also expecting Nintendo Switch to come out in 2021. So that new generation of consoles should reignite the purchasing cycle of video games and increase sales of merchandise. Which brings me to another sort of good point, is that right now the revenue streams for the video games, they became way more diversified than they were before, and stores like GameStop actually make a lot of money on the licensed merchandise. Talking about diversifying revenue streams, video games are more profitable than ever because gone are the days when you can just buy a video game for $59.99, play it, and it was the end of your expenses. Now sometimes you gotta pay for subscription, there is in-game purchases if you want to buy skins. It became way more profitable for the publishers. And what's going for the GameStop is also publishers do not want to be tied up to any ecosystem. This is evident if you're gonna see right now on the rift between Epic Games, the creators of Fortnite, and Apple. Basically, Epic Games make a bunch of money on in-game purchases like skins, but Apple is taking 30% cut of every purchase. So Epic Games doesn't like it. Of course, the problem is that the Apple Store is a great marketing and discovery vehicle for the publishers. So in theory, GameStop has a benefit here because they can provide that marketing and discovery vehicle without taking that 30% cut of every single transaction. So perhaps newer publishers or for the new titles, they can prioritize GameStop over other ecosystems. Let's get in the weeds here and talk a little bit about short squeeze, because a lot of people think that's exactly what's going on with the stock price here. And if you don't know what short selling is betting on the fact that stock price will go down. And physically the way it works is you borrow the stocks from your brokerage, you sell them right away, then you're hoping you're going to repurchase them at a later date for a cheaper price. And during that time period where you didn't repurchase the stock price, you're gonna keep paying the difference in your margin account. So if all of a sudden the stock that you shorted, where you're so sure it's gonna go down, they're gonna go out of business, aka GameStop, all of a sudden gains 100% up, you become worried because you have to repurchase the stock and bring them back. So what a lot of times happens when it keeps going up, the short sellers are forced to buy the stock because they're afraid it's gonna go even higher up and bring back the shares to the brokerage. But of course what happens is a lot of people all of a sudden keep buying the stock because they're trying to close their short position, which pushes the stock even further up. And that's what's called short squeeze. And a lot of people think that this is exactly what is going on with this stock, because a lot of people shorted GameStop and now it's up 100%. So short sellers have to close their positions. Now when we know some of the positive factors that are pushing the stock up, let's look at the negative factors. And number one, I think saying that you're gonna compete with Amazon is not enough. You gotta realize that companies like Amazon and Uber, they spoil the consumers because they invested probably billions of dollars in testing their user interface and making it as frictionless as possible. I can give you an example. Yesterday, I tried to order food from my favorite restaurant here, and they kept telling us, like, don't use Uber Eats, please use our own system because we keep way more money, and if you want us to stay in business. So I'm like, all right, I'm gonna register for that. It took me like 20 minutes to go through their online system. It didn't work, it was so cumbersome. In the end, I just ordered it from Uber Eats because it was so much easier. So for the GameStop to develop a system that is actually going to be frictionless and will convince people to download another app on their phone, to use another interface, it's going to take a while, and I don't know if it's actually can be done. Another negative factor that I see here is, while we're talking about how profitable the gaming industry is and how profitable those multiple revenue streams are, you got to realize that most of them go to the publisher, because all of those in-game purchases, all of those new skins, the GameStop is not gonna get any cuts of that. So they're still making money on the margins when they sell the game or when they do the merchandise, or actually they make most amount of money on the trading games. So all of that growth in the revenue is not really impacting GameStop as much as it impacting the publishers of the games. Finally, all those positive and negative things I told you, they're not concrete. There's something you put in a headline so people click on the article. If you really want to evaluate what is going on with the company, what is their plan, we're going to look at their financials. And I'm going to go to a computer in a second to really look at the financials and the risks so you can see what is going on with the company. All right, I got to the computer to download the 2019 GameStop's annual report. I went through it, and here are a few interesting sort of notes that might weigh on your decision whether you should purchase the stock or not. So number one, in the risk section, they're saying that they obtain higher margins on pre-owned products. The issue with that is that they're all done in one centralized facility, so any disruption to that facility will negatively impact profit margins and probably revenue. And of course, I'm thinking the risk is not only in some sort of impact to the facility. The risk right now in the pandemic is how many people are actually going out and trading their games or consoles. So that's kind of a major risk for me in the short term, on top of all other sort of typical business risks. Okay, the next red flag that I saw is that they use revolving credit facility, which is basically like a person taking credit line to really finance their operations and guarantee obligations and do a lot of things. The issue with that is, first of all, they're paying pretty high APR, 6.75%, and it expires pretty soon in March 2021. So once that expires, I have questions like, will they be able to renew it? And if they can, will that be at 6.75%, or it will be higher, or it will be lower? But that's definitely something that's materially affects their operations, because that's what they use to make sure that they can guarantee their lease obligations. Another red flag that I saw is that in March 2019, they repurchased their shares. And if you don't know my opinion about that, watch the video about Apple's share repurchase program. The idea is that it's artificially pushing the price up. And when you have some money in the bank, okay, you know, that's the way to return money to your shareholders and has tax advantages. But this company is not making any money. This company is using that to fund its operations. Why would they repurchase the shares in the middle of this when every dollar counts? This is your runway to pivot your company in some way or form and stay afloat. So I really do not like when companies do that. That just artificially attracts investors that just buy the company just for that share repurchase. Finally, let's look at their financial statements and see what's going on there. Okay, so on the balance sheet, they have $500 million in cash. Then there is like merchandise that I'm not really sure if it costs anything. Right of use assets, that's not real money either. And then they have accounts payable, liabilities. It's not the worst balance sheet in the world, but it's not super strong. Pretty much what cash they have equals their liabilities. Now, when we look at the net income, which, as again my profs always would say, net income is an opinion, cash flow is a statement, but I already looked at the cash flow. It matches with net income pretty good. You'll see their sales were dropping for a while now by around like $2 billion from 2018 to 2019. The cost of sales was reduced as well, because when you sell less, you incur less costs, less transaction charges, you need to buy less of the merchandise. So, you know, the gross profit and the margins actually stayed consistent or even looks better if you do the calculation. The problem here is that there is this selling, general and administrative expenses, and that stayed pretty consistent. And in 2019, the SGA, that's a short for selling, general, administrative, was actually higher than the gross profit, which kind of wiped everything off. And then when you add all other items, your net loss was $470 million. And it was net loss 673 in 2018, which you might say it's actually better, so they're improving. But I think the big item here was the goodwill impairments. And goodwill is when you buy a company and there's like intangible asset like brand on the balance sheet, you put on goodwill. Basically it's BS. Usually it's not worth anything. So when they wrote off $970 million in goodwill impairments, that's actually not real money. Like it did not come out of their account. So in 2019, they only wrote 363. So they're not actually doing any better in terms of generating net income in 2019 than they did in 2018. Okay, let's look at the cash flow report, and it does echo the net income. You can see that the goodwill was added back, which means that in 2018 they actually had a positive $325 million in operating cash flow going into their account, but in 2019 it was minus 414, so that's a swing of 700 million. And remember, 2019 was before pandemic, before the store closures, before it was hard to trade in your games. And at this point, they've been for years in their restructuring and renovation and pivoting their business. So when you sit here and you purely look at the numbers and you read an article that they're going to beat Amazon in their own game, it's just very hard to imagine how are they actually going to do it and how much influence does Ryan Cohen has. I also, what kind of pissed me off here is that in 2018, when you look at the net investing activities, they actually raised money, 635 million. And what did they do with them? They repurchased shares with them. So like there's really the only way why they did it is to manipulate, to increase the stock price. So with the financial statements, what I was really interested is the selling, general, administrative expenses. What goes in it, and why they're so consistent, and can they reduce it somehow? What's their plan? So I started looking for that statement to see, what do they write about it, and I went through every single note. And there's like little note like explaining how much it went down, like, oh, it went down by 3.6%, which I don't really care. I can calculate it myself. Some of it actually went down because of the foreign currency, because of the exchange rate was positive. It actually helped them. So one thing I did find that the cost of loyalty cards is recognized in selling general administrative expenses. Okay, so that's one cost, but how many loyalty cards do we have? And then finally I got to this paragraph about classification, and it didn't say anything. Basically it says the recognition varies across retail industry. We include certain purchasing, receiving, and distribution costs in SG&A in the consolidated statements of operation. The processing fees are included in cost of sales. So basically it tells me nothing. So I know that the purchases, the credit card purchase fees are in here. Okay, that's good. That's where they're supposed to be. But I have no idea what's going on into this number. And as you can see, it's a major number because it wipes up all of the gross profit. So when I look at the financial statements, my conclusions are that even before pandemic, they were not really making money. They engage in share repurchases, and I have no idea how they're going to turn around. How are they going to increase this profitability? Because this gross profit margins is great, but it gets wiped off. So I literally have no idea. And that brings me to the conclusion of this video. In summary, when you take the possibility of the short squeeze scenario and you look at their financials, my opinion about the GameStop company is that I have no idea what is happening and where it is going. For me, this is super risky. It is in a gambling territory, same like going to a casino. So me personally, I wouldn't be investing in the stock. I wouldn't even call it investing if somebody buys it. This is pure gambling play. So for example, if you do believe in the gaming industry and you want to make sure you have exposure to it through your portfolio, there are probably better, more solid companies with good cash flows that you can invest today and reap the rewards of that growing, diversifying revenue streams and games becoming more profitable. But bottom line, what I want you to take away from this video is that don't buy into hype. Don't read the news, oh, it went by 22%, Ryan Cohen is gonna turn it around. Try and make your own educated decisions. So whatever you do, whether you buy it, you don't do anything, you do it knowingly. Don't buy into hype, don't buy into fear of missing out. Thank you for watching. Until the next time.